Hello, welcome. For those of you who are new to me, my name is Audrey Faust. I'm a financial coach. I'm also the founder of Financially Empowered Sisterhood, which is a group program where I teach women how to create a path to prosperity. And in that program, one of the things we learn is how to start investing on our own without a financial advisor. Now, it's completely fine if you want to hire a financial advisor, but I've grown my wealth completely on my own. I'm not a financial advisor, and I want to show women how easy it is. But a lot of what holds people back is fear. Okay. So that is the first thing that we need to overcome. So today, what I want to do is educate you a little bit on the stock market and how it works. So I'm going to share my screen and I'm going to show you exactly what is happening and why. And the way I've built most of my wealth is through mutual fund investing. And if you're not familiar what a mutual fund is, it is a conglomerate of a bunch of companies. So you're not investing in just one company in the stock market, like Apple or Amazon or something like that, that if something would happen, you allude to that company, Enron for example, then you would lose all of your money. So mutual funds is a conglomerate of a bunch of companies that a fund manager picks. And the fund manager is trained to look at companies' financials, understand what they say, and make the best decisions for that fund. And each fund could have hundreds of companies in it, and they all have a different target market. But I want to tell you a little secret. It's really hard to choose wrong in a mutual fund. The higher risk ones are more targeted. So I would stay away from them, especially if you're not in it for 30 years or 20 or 30 years. They can see more volatility. So, but just general, index 500 or index funds in general. And what index funds are actually, index funds aren't even selected by a person, by a fund manager. Index funds are just following the stock market identically to a certain index in the stock market. And there's a bunch of different indexes, but you can also go with a fund manager fund. I get into, in my program, I get a lot deeper into how to pick a mutual fund, but I wanted to just share with you a little bit today how the stock market works. So I'm going to share my screen and I'm going to explain to you the ups and downs. All right. So share my screen. Okay. So this is the Dow Jones Industrial Average. And often if you're listening in the news and in TV, this is kind of what everybody refers to as the stock market. And you're going to see, this is 1 day here, fluctuation. This is 5 days. You can see this week, the stock market has gone down in the last 5 days. This is 1 month. This is 6 months, year to date, 1 year. And today I'm going to talk to you about 1 year and 5 years. So mutual fund investing is for the long term. If you're investing at all in the stock market, it should always be for the long term. If you're a professionally trained day trader, that you do you, but what I teach is investing for the long term. And you can see this is over the last year what the stock market has done. And if you're investing in a mutual fund, you'll see the same type of thing actually happening in your mutual fund, all these ups and downs. So what I teach people to do is to dollar cost average. So you're going to hit every single month, all these ups and downs, right? And that's the best way. That is truly the best way to grow your wealth. Uh, but what I love to look at when I talk about investing in mutual funds, and in my group, when I teach them how to invest in mutual funds, what we look at is the 5-year. So even though if you look at the 1 year, we're down. We're not doing so great here. If you look at 6 months, we're really down, right? In the stock market. If you look at 1 month, we're down. Again, mutual fund investing and investing in the stock market, this is why it's long term. So 1 year, we're up a little bit, but not a lot. Well, maybe we're about even for a year, it looks like. And then 5-year is really, if you want to invest in a mutual fund or the stock market, 5 years should be your minimum to look at it. So if you look at all these ups and downs over 5 years, you can see how investing in the stock market, you've gotten all these ups and downs. What happens to most people is when the stock market takes a dip, like it did right here in March of 2020, that was COVID. People get scared and they pull out of the market. So they're pulling out of the market all the way down here. And then when they feel safe again, maybe like a year later, they're putting their money back in the market. Let's look at it about a year. Let's say they took it out for a year. And here, yeah. So here's a year later. Look at all of that growth that you've lost from, even if you look at the high point right before COVID was here at 29,000. A year later, if you look at March 2021, you're at 33,000. So you've already lost money. Not only if you pulled out way down here, you're at 19,000. So you lost this money and then you come back a year later and you just feel safe again and you put your money back in and it's already up here. What I love to say is when you see these dips, that's the best time to put money in. Here, September of 2022, COVID hit right here. You know, this would have been the best absolute time to put your money in. When everybody else is pulling their money out, that's when you do the opposite. You start putting more in. But regardless, if you didn't have a ton of money to put in and you continued your dollar cost averaging, you would have hit all of these peaks and valleys. And 5 years later, you're at, even though you're looking, if you look at the 1 year, we're at a low, right? 32,000 for the low. If you look at the 5-year, you're still ahead. 5 years ago, the stock market was at 25,000. Now it's at 32,000. You're still ahead 5 years later, even though people are saying the market's down right now. The stocks are on sale. Well, I like to say the stocks are on sale. That just came out. But that's kind of my favorite thing. When the market goes down, I always say stocks are on sale. It's time to buy. So if you're invested in something called like the S&P 500, well, this is the S&P futures. This is trying to predict the market. Let's not go there. Let's go back. But the Dow Jones is just a good reference of how you're going to see your mutual fund go. And if you're in a common mutual fund that's not too directed, here's the S&P 500. So if you're in an index 500 fund, right, you can look at, let's look at that. So this is exactly what your index 500 fund is doing, the S&P 500. So boom, you can see a very similar trajectory, right? 1 year, they're not quite down as much, right, as the Dow Jones. 5 year, 5 years, you know, we're all looking about the same. we're all looking about the same. So 5 years S&P, 5 years. Now we're in futures. Dow Jones. It has a similar form to the graph, right? So this is what I wanted to share with you today. And I hope this helps you get started, even if you can invest on your own, even if it's just $50 a month. And you can keep growing that and growing it. That's what I started with. I started with $50 a month and 25 years ago. And I've grown my wealth exponentially over the years. And I mostly through mutual fund investing, a little bit through real estate. But reach out if you have any questions. I love to hear from you. And I hope this was helpful.